David R. Guttery is the president of Keystone Financial Services in Trussville, Alabama. David Guttery is a financial advisor who represents Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, President of Keystone Financial Group here in Trussville, to provide insight on 5 burning questions that are on the minds of many at this present time. David, thanks so much for joining us. You know, in recent videos, you've discussed encouraging signs of economic green shoots and other positive observations. But today, I'm going to put you on the spot about 5 questions that are being debated in the business media. In your opinion, is there a threat of the dollar being replaced as the reserve currency of the world? Is this the beginning of a new banking crisis? Are we going to experience a deep and long recession? Can market participants trust the Federal Reserve? And lastly, could this debt ceiling standoff in Washington result in the United States defaulting on its obligations?
Great questions. And yes, I have opinions on each of these. So let's unpack them one at a time. In my opinion, no, the U.S. dollar will not relinquish its status as being the reserve currency of the world. I realize that much has been made of the BRIC countries seemingly colluding to undermine the status of the dollar. Recently, we learned that Brazil and China had forged new trading arrangements to be consummated in the respective currencies of each country rather than U.S. dollars. I would like to point out that this is not a new development. Many countries have, at times, demanded that trade be consummated in their domestic currency. Most recently, Russia has demanded that sales of natural gas be consummated in rubles, for example. I would suggest to your viewers that, in my opinion, the only country capable of dethroning the United States dollar as the world's reserve currency is the United States. In my opinion, the dollar came to have its reserve currency status because of our history of being fiscally responsible. We can undermine that if we haphazardly manage our financial disposition. We are the largest economy in the world, and for many countries, China included, we are their largest trading partners. Regardless of how much smaller countries choose to consummate transactions, it does nothing to undermine the status of the dollar or the degree by which the United States can exact its economic will throughout the world. Indeed, federal researchers have referred to this as the empirical circle. When the dollar strengthens, it tends to decelerate global trade and growth. Since the United States' economic growth is less dependent on the rest of the world, this increases the attractiveness of dollar-denominated assets for foreign investors. In turn, this bolsters the dollar's dominance as being the world's reserve currency and further strengthens the currency's value. Nothing has happened recently that undermines this effect. I will admit that it makes for sensationalized headlines, but in my opinion, I can see nothing of concern that can be quantified on a spreadsheet to justify this fear.
Okay, that sounds reasonable. So for the second question, the failure of Silicon Valley Bank and 2 others have recently made headlines. What opinion can you share with our viewers? Is this the beginning of a new financial crisis?
Again, great question. In my opinion, no, this is not the beginning of a new 2008 style financial crisis. This is a long and complicated subject, so I will try to be brief for the purposes of this video. There were several nuances of Silicon Valley Bank that were unique to it, including the high percentage of uninsured deposits and corporate nature of its depositor base. It has been reported that managerial issues were of concern, and there may have been a lack of sufficiently tight risk controls. In spite of this, I would suggest that were it not for the precedent-setting actions of the Federal Reserve, we may have never heard of Silicon Valley Bank. I would remind to your viewers that the Federal Reserve spent 30 months printing money and debasing the currency by 36% as they became the world's single largest central purchaser of Treasury debt during the COVID pandemic and in the year following the reopening of the economy. The new piece of Treasury debt that the Federal Reserve purchased funded the trillions of dollars in new spending programs promulgated by Congress to bridge the gap following the closure of the economy. Again, this is a complicated issue, but at a high level, those dollars have now backwatered into the banks, and the Federal Reserve is trying to drain lendable reserves from the economy. In this chart from Bloomberg, you can see the year-over-year change in the M2 money supply. Let me provide an analogy that will probably make sense to your viewers. At the beginning of the year, we suffered a water line rupture in my building. The remediation company suggested that if we did not control the humidity in the building, that a mold problem might result. Therefore, the first course of action was to eliminate the inch of standing water that was throughout the building. If the concern is to eliminate the threat of mold, then we must address that which creates the humidity first. The Federal Reserve has constantly stated that avoiding stagflation is a primary goal. Stagflation at a high level is simply an economy going nowhere while suffering hyperinflation. Inflation is simply too many dollars chasing too few goods. Following the recovery from COVID, we have too many dollars in the lendable system. In its effort to mitigate the risk of stagflation, the Federal Reserve, among other things, is eliminating the standing water on the floor, money in this example, before it can control the humidity from which a mold problem might result. Why is this important? Because according to the most recent Federal Reserve stress test of major banks, the financial system appears very healthy. At a high level, banks are flush with cash right now, and this is part of the reason why the Fed is moving to drain those lendable reserves as quickly as possible, but in an orderly manner. This chart is from page 9 of the most recent executive summary of the stress test of major financial institutions conducted in 2022. The graph depicts the aggregate common equity capital ratio of large major banks, representing by proxy the entire banking system. This chart, in my opinion, indicates that the banking sector was as healthy as it had been at any time since the 2008 financial crisis. Furthermore, the executive summary noted that aggregate common Tier 1 capital was at 12.4%. This is significantly higher than the required threshold of 10%. So in terms of what can be translated to a spreadsheet, no. Banks appear to be flush with cash and lendable reserves, and this explains part of the reason for the aggressiveness of the Federal Reserve and their efforts to drain those lendable reserves and avoid stagflation. In my opinion, the sector is healthy, and what we have seen from Silicon Valley Bank, Signature Bank, and First Republic seems to be a function of matters that were unique to these banks and not indicative of a systemic problem beginning to unfold.
Well, thank you for that clarity, and that sounds reassuring. So, on the matter of recession, can you share with our viewers your opinion as to whether we are in a recession or will be in one?
Absolutely. Over the previous year, I have stated on many occasions that, in my opinion, we would find ourselves in a shallow recession that could potentially last for a long time. Shallow in frequency, but long in duration. Again, to answer this question alone would require more time than we have for this video. So in terms of what I can quantify on a spreadsheet, let me offer this graphic. This is the leading economic index, and it is comprised of 10 leading economic indicators. It's designed to provide insight as to the future trajectory of the economy. In my opinion, market participants believed that we would find ourselves in a long and deep recession, much like what we experienced during the 2008 financial crisis. You can see that period of time depicted on the left side of this chart. Today, the leading indicators are suggesting a much more shallow and run-of-the-mill recession, and it seems to be that which is developing. This is exactly what I have described in my previous videos, and now we are hearing from other economists too that believe this to be the case. In our previous video, I suggested that we might find ourselves in a rolling recession and offered my opinion as to what that would mean to us economically. Today, I am hearing many other economists share the same suggestion. I understand that there is a lot of fear reflected in market valuations of a recession that does not appear to be materializing. That doesn't mean that markets can't or won't worry about things that you can't quantify, But it is 4 times like this that investors must separate themselves from sensational noise and focus on that which is quantifiable. So in my opinion, yes, I believe that we are either in a recession now or will shortly find ourselves in a recession. But furthermore, I don't think it will be the kind of recession that the markets have anticipated.
Well, thank you, David. You have often spoken about the Federal Reserve and the market's response to their efforts to remove accommodation. And in your last video, however, you suggested that, in your opinion, markets were shocked last year at the aggressiveness with which the Federal Reserve proposed tightening. So, in your opinion, will the markets ever come to trust the Federal Reserve again?
Honestly, I believe that the Federal Reserve has been transparent throughout the process. They have done exactly what they said they would do. Within our last video, I mentioned that tightening, at a high level, was the process through which inflation is controlled. We also observed the previous comments of the Treasury and the Federal Reserve as they suggested that inflation was transient and short-term. Therefore, I believe market participants were expecting a much more mild and tepid approach to the removal of accommodation. Clearly, the approach to accommodation was not expected by the markets. We have observed the most aggressive approach to tightening that we have seen in over 35 years. So yes, this has, in my opinion, made markets reticent to believe that the Federal Reserve will remain true to the guidance that was provided in November, and that the Federal Reserve would take a less hawkish and more data-driven approach to the further removal of accommodation. In the 7 months since the November 2nd meeting, the Federal Reserve has not deviated from their previous guidance. Indeed, in my opinion, the minutes from the last meeting offered some of the most dovish comments that I've heard in over a year. Market participants have seemingly not returned to having confidence in this guidance, but I do believe that over time, with consistency from the Federal Reserve, this will happen. So yes, in my opinion, I believe that the Federal Reserve can indeed be trusted. They are not a fourth branch of the government. It is an autonomous organization with a dual mandate that does not include placating the desire of any given administration. In my opinion, I believe that they have remained true to these mandates and to the previous guidance provided. So in my opinion, yes, the Fed can be trusted.
Well, David, that makes sense, and hopefully this continues without further shocks to the market. So last question. In your opinion, will this standoff in Washington over the debt ceiling result in a potential default on U.S. obligations?
Again, such makes for sensationalized headlines, but no, in my opinion, I do not believe this will be the case. I would like to ask your viewers, when was the last time that the United States defaulted on its obligations? It has never happened. Looking back in history, we have had many times when other periods of standoff resulted in what the media refers to as the government being shut down. Not that long ago, House Speaker John Boehner and President Obama had 6 such impasses, and on a few occasions it resulted in the function of government being encumbered, but even then, it never resulted in a default of the United States obligations. So those in the media who are suggesting that it will happen this time are predicting something that has never occurred. Personally, I am much more inclined to find comfort in that history rather than wasting a minute worrying about something so cataclysmic happening for the first time ever. So in my opinion, no, I do not believe that this current debt ceiling impasse will result in something as ominous as the United States defaulting on its obligations.
Well, David, these have been very insightful answers, and we appreciate your opinion. In closing, what advice would you give to our viewers as it pertains to actionable information?
I would simply say this: if you can't put it on a spreadsheet, then it doesn't exist. Among other things, one major obligation that I discharge to our clients is having a thick skin. My job is to separate facts from sensationalism. One tried and true way to achieve that end is to research and quantify factual information. So let me give you a pilot's analogy. There are times when visibility through the windshield is obscure, if not opaque. It is at such times that you need to be skilled in flying by instruments. At the present time, we are relying heavily on such instruments. These instruments are pieces of factual data and historical anecdotes that give us reason to perceive the future as being something other than which is being cast sensationally in the various mass business media. Stay true to your objectives. Review your parameters of risk. Remain focused on the fruition of planning objectives. And remember, we are on the cusp of what promises to be a highly politicized election year. Sensationalism will likely increase as we get closer to next year, so it is imperative to insulate yourself from the noise. Fly by instruments, be swayed by quantifiable data. Remember, data is neither red nor blue, it isn't black or white, north or south, or anything else. Data is data. We run into trouble when we try to view that data through a prism of our choosing that distorts it to suit our purpose. Let factual data be just that, and rely only on that for actionable information. Tune out the sensationalism, especially now.
Well, David, as always, thanks so much for this information. And for additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brandon Dawkins.
David Guttery independently offers securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.